What's up traders, welcome back to the channel. Today we're tackling the absolute bedrock of profitable trading. Forget fancy indicators or complex strategies for a second. If you don't master what we're covering today, the 1% management rule and how it dictates your position size, you're setting yourself up for failure before you even place a trade. This isn't just a rule, it's your financial seatbelt in volatile world of trading. Stick around because I'm gonna break this down with crystal clear examples so you can apply immediately. Look, here's the fundamental truth that beginners often ignore, and it's cost them everything. You will lose trades. It is 100% impossible to win every single trade. The goal isn't to avoid losses. The goal is to make those inevitable losses small enough that they don't cripple your account. This is where risk management comes in. It's your survival strategy. It ensures that when you are wrong, and you will be, the damage is minimal. Without a concurrent risk management plan, especially regarding how much you risk per trade, you're essentially gambling. And that leads to the all too common story. Massive oversized positions that get wiped out by one or two market moves, blowing up the account entirely. We've all seen it, maybe even experienced it ourselves. It's brutal. So, how do we fix this? By implementing rules that protect our downside. And the most widely accepted, battle-tested rule for managing risk at the individual trade level, one that I personally advocate for beginners and intermediates, is the 1% rule. What does that mean in practice? It means before you even think about clicking buy or sell, you calculate 1% of your current trading account balance. This dollar amount is the absolute maximum you're willing to lose if the specific trade goes against you and it hits your stop loss. For example, let's say you have a 2000 trading account. Your maximum loss per trade is 2000 multiplied by 1%, which equals to $20. That's it, $20 maximum. Now I know what some of you are thinking. $20 loss? That's peanuts. How am I supposed to make real money only risking $20? Hold that thought. We'll address that excitement factor in a bit. Right now, we're building the foundation for longevity, for staying in the same game long enough to actually make money consistently. For any trader, but essentially, when starting out, sticking to 1% is crucial. Building confidence, get consistent, then maybe consider moving towards 1.5% or a maximum of 2% only if your strategy and psychology can handle it. But for most traders, 1% should be the gold standard. It's the rule of thumb that has saved countless trading careers and allowed traders to compound their capital safely. Now here's where many traders misunderstand the risk rule. It's not about knowing your max dollar loss. It's about how the max loss dictates your position size. This is crucial. Your position size. How much shares, contracts or units you buy or sell is not random. It's determined by your 1% risk and the distance to your stop loss. Before you enter any trade, you must know two things. 1. What is the maximum acceptable dollar loss for this trade based on the 1% rule? 2. Where am I placing my stop loss based on the chart's price action? And the second point is key. You place your stop loss where the chart tells you your trading idea is wrong, based on support and resistance, trend lines, chart patterns, whatever method you trade. You don't place your stop loss based on how many shares you want to buy. This is a huge mistake. I'll do a full video on exactly how to place stops effectively. Make sure you subscribe so you don't miss that. But for now, understand that the stop loss level is determined first. Once you know your max dollar loss, $20 in our 2000 example, and your stop loss level, which tells you your risk per share or unit, you can execute your position size. Let's use a couple of examples to make this crystal clear. Example 1. Sticking with our 2000 account, max $20 loss per trade. Let's say you want to buy a stock currently trading at $10. Based on your analysis, the logical place to put your stop loss is at $9. Your risk per share is $10. Entry minus $9, which is the stop loss, equals to $1 per share. Now calculate your shares. $20 max loss divided by $1, which is the risk per share, equals to 20 shares. by buying 20 shares. If the stocks goes down and hits your stop loss at $9, your total loss is 20 shares multiplied by $1 per share, which will be $20. Exactly your 1% limit. Perfect. Example 2. Same 2000 account, same $20 max loss, same stock trading at $10, but this time based on the chart, your logical stop loss is tighter at $9.5. Your risk per share is $10 minus 9.5, it equals 50 cents per share. Now calculate your shares. $20, which is the max loss, divided by 0.5, which is the risk per share, equals to 40 shares. See the difference? With a tighter stop, you can buy more shares. Still stay within your $20 risk limit. This is the power of proper position sizing tied to your risk management. You're not guessing, you're calculating precisely how much you can afford to trade on that specific setup. And going back to that point about it not being exciting to risk only $20, yes, a single $20 loss on a $2,000 account isn't thrilling, but winning $40 or $60 on the same $20 risk, which is a 2-to-1 or 3-to-1 reward to risk ratio, builds your account steadily. More importantly, consistently risking only 1% means you can survive a losing streak. If you lose 5 trades in a row, you're only down 5%. $20 multiplies 5 equals $100 on $2,000 account. That's easily recoverable. Risk 5% or 10% per share and 2 or 3 losses can wipe you out completely. Which scenario sounds better for your long-term trading career? Protecting your capital is the number one job of a serious trader. It's the holy grail, more important than any indicator or chart pattern. Master this and you give yourself a fighting chance. Ignore it and your trading journey will likely be short and painful. Alright team, now that you understand the formula, I want to see you put it into practice. Right now, I want you to open up your brokerage account balance, calculate your 1% max loss per trade, then comment down below and tell me what is your account size and what is your calculated maximum dollar loss per trade based on that 1% rule. Let's get everyone on the same page. For example, if your account is $1,000, your 1% max loss is $10. If your account is $2,000, your 1% max loss is $20. Let me know your number. And listen, if you have any question at all about this breakdown, the 1% rule, the position sizing, or any other trading topic, please drop them in the comments section right below this video. I personally read through the comments and I'll get back to you with detailed answers as quickly as possible to help you on your trading journey. Thanks for watching, traders. Until next time, trade safe, manage your risk, and I'll see you on the next video.